All right, we are live. Welcome, closers. Today, we're going to be talking with Noel Christopher of Riddims Warehouse, and we're going to be talking about acquisitions and consolidation in the property management industry. I don't have to tell you that that's a relevant theme right now. I don't have to tell you that there's a lot of outside capital that's coming into the industry, that the industry is getting hotter and more attractive to a lot of different entities and companies, both large and small. And so today with me, I'm bringing on Noel Christopher, who is the SVP of Business Development for Riddims Warehouse. Noel, thanks for coming on today.
Thank you. Happy to be here.
Noel, how long have you been with Riddims Warehouse for?
I've been with Riddims Warehouse for about a year and a half.
And what's basic job role of what you do for the company?
So I'm responsible for property management acquisitions, as well as strategic partnerships. And then I work a lot with some of our, because I've been in the industry for a while, work with some larger single family rental investors that we're taking on with our portfolio services division.
Very cool. All right. So before we get started and dive in, I just want to mention a couple of housekeeping notes. The first is that you can and you should ask questions. At the bottom of this page, there is the ability to submit a question. Ask your own question. Vote for somebody else's question. We're going to go through as many of these as we can towards the end of the interview. So as you're listening, if something comes up, something you're wondering, just pop that in down below. The other thing to mention is that today's Crowdcast is sponsored by the PM Growth Summit. We are now opening up ticket sales, so you can actually see that there is a link down below where the green button that says 2018 PM Growth Summit. Go check it out. It's an amazing growth-oriented event for property management entrepreneurs. San Diego, February 1st and 2nd of 2018. You guys want to check that out. Noel, you were there last year for the inaugural event. Was it worth your while?
Absolutely. The content was amazing. I really learned a lot. Somebody who is a little newer into the actual operations of property management myself. I thought it was amazing, and I really enjoyed it.
Awesome, man. All right, well, let's kick it off right here. The first question I have for you, Noel, is who is Riddims Warehouse and why does it matter? I've got some context going back to probably 2010 or so. I think it's an interesting company doing interesting things, but for those that don't know, give us some background on the Riddims Warehouse story.
Sure. So Riddims Warehouse, as you mentioned, you've known of them for a little while. And most people know of Riddims Warehouse as a franchisor. And that was the case since 2008 until about 2015, Riddims Warehouse was our franchisor. So we had several franchises. We followed that model. It was very successful. And in fact, successful enough that in the end of 2015, Riddims Warehouse was invested into by Northern Pacific Group, who bought a majority stake. And at that time, the strategy of Riddims Warehouse changed dramatically. We looked at the market, looked at what was going on, looked at the institutionalization of the single-family rental asset class, and decided having a corporately owned, centrally managed business model was going to be the right path going forward. So what happened was that we started buying back a lot of the franchises, looking at an acquisition strategy in multiple markets to expand our brand corporately into several markets through property management acquisitions, through franchise acquisitions, through larger single-family rental customer acquisitions, and then organic growth into these markets. So, where we are now, we're led by Kevin Ortner, our CEO, who's been with Riddims Warehouse since the beginning. And we're now corporately, we're at about 14,000 doors. Along with our franchises, we're at 19,000 doors, serving about 13,000 investors in 42 markets in 25 states. We're still in the process with some of other franchises, working with them to maybe come on board, maybe not. We're still completely servicing our franchise franchisees. We're just not adding any new franchises right now.
Okay, so give me some context about the early days, because this was very much a mom and pop startup, right? I mean, from day one, the culture may have been different, but this is a dude with the dream and a vision starting a company long before it got acquired by a private equity group. So can you just talk a little bit about that early growth and success that was the lead in? Like what did that look like, and what kind of success was had early on before it was bought and assimilated by the corporate mothership?
Sure. So, Brenton Hayden was a founder of Riddims Warehouse, and he did an amazing job at building an incredible brand that really had a lot of disruption in the property management business model, going to a flat fee model, the customer service that we offered, how we branded ourselves and branded Rent Estate. And, they started like any other entrepreneurs with, a few properties to manage and a phone book and hitting the streets and really growing the business. Like many of the, many people that do. And, that entrepreneurial spirit hasn't changed in the company. Riddims Warehouse, we may be bigger and have grown, but we're still just a bunch of entrepreneurs trying to grow a company and grow it at scale. And that we've kept that spirit along the way. And Brenton did an amazing job at growing this company, and is still does great things. And so
let's quantify that in the one market though, because at the end of the day, this company was a meaningful brand and presence, a dominant brand presence in one market before it was something meaningful in other markets. So in the Minneapolis market, how many doors in Minneapolis, what kind of estimated market share today as well as prior to the acquisition?
So, I don't know. I don't know if I can speak to the exact market share, but I know we're at about 6,500 doors in Minneapolis.
In one market. And what percentage of that is multifamily versus single family?
Oh, it's 95%, 97% single family.
That is impressive. 6,500 doors in one market. I know you can't speak exactly to the market share, but let's make a pretty fair assumption. That's a pretty high percentage of the market share. And what's interesting to me, Noel, is that the company, we'll get into this more in terms of the growth tactics and growth strategies, but I want to talk about the economies of scale and the unique opportunities that come with managing that many doors in one market. You can act like a different class of company with that level of market penetration. I want to get to more into that later, but I want to now transition to talking about the background of the private equity company. What was the opportunity that they saw, and that frankly a lot of people are seeing by investing capital into the industry, and how has that changed how the company is run, going from mom and pop to now being acquired?
So, Northern Pacific saw the opportunity. I mean, Northern Pacific Group's based out of Minnesota. They are, very savvy group of people, and they saw the opportunity in Riddims Warehouse in this asset class as single family rentals, what's going on, and the recurring revenue opportunity, and how building out the scale of the business in Minnesota and taking that model and growing it to multiple markets, rolling in the franchises, and they really saw what the opportunity was. And going forward, we've had full support from Northern Pacific Group. They're not involved in the actual day-to-day management of the company. We're out there growing the company, taking a lot of technology initiatives, and really, what we do today is going to be different what we do tomorrow as we grow more and more and more, and we're learning our lessons as we go along. So it's been very, very interesting in that sense. But we've had full support by Northern Pacific Group along the way, and it's been really exciting because, what's changed is that anytime you grow from, even at, the scale that Riddims Warehouse was as a franchisor and in Minneapolis, as you try to grow a corporate model through multiple markets and through acquisitions, and as you know, the property management business, there's 100 different ways to manage a property. We're having to standardize processes. We're going away from I would say, a portfolio management style to really more of a CSR style, where we have to be able to our owners have to be able to call in and talk to somebody and get all the answers. And to scale that, it takes a lot of technology and a lot of even a lot of heartache of lessons learned. And like anybody, we're learning our lessons as we go along. Not a lot of people have done this in this type of business. The 13,000 customers, it's tough to keep them all happy at one time. And you really have to have the right model in place and to scale that and not implode in yourself, which you see a lot of businesses as they scale, they can't keep control. And so we see all those same issues and we go through all that same heartache. Right. And we're no different than anybody else in that sense.
So let's talk about the influence, at least on the strategic planning level. The growth targets, the ambition, et cetera, has transitioned from being a guy with some guttural level kind of life achievement goals on an entrepreneurial type level to now being presumably much more exacting, specific, and aggressive in hitting goals. What is the 3 to 5 year plan? Where is this company trying to go? Just talk about kind of the long-term outcome that the corporate vision has.
Sure, absolutely. So, what we've done is we've really right now we're really focusing on our centralized services and at the same time scaling the business in a measured way. As we're getting better at our centralized services and our acquisitions, we're really trying to ramp that up. So this year, we're at let's say 19,000 plus doors. We'd like to end the year at 24,000 doors, 25,000 doors possibly. And then going forward, we would like to double that next year and double that the year after. I mean, we'd like to be in the 3 to 5 years. We're talking, or 1 to 3 years. 3 years at 150,000 doors. I mean, that's a realistic goal for ourselves. And it's, like I say again, I keep focusing on the technology and the processes, and those are so important to be able to manage that size of a portfolio and really have a true centralized service. What makes us unique and efficient is to be able to have the boots on the ground that are focused on the local market and focused on managing those stores and taking away all of that administrative and data and invoicing and payroll and rent collections and maintenance coordination and evictions, put all of that into our corporate office and as well as the repairs and maintenance, and let the guys in our local market focus on growing the market, managing the doors, that level of customer service that you need locally. You can't just manage everything from afar. You have to have a little bit of both. So sometimes there's some misconceptions there. We're not just sitting in Minneapolis hoping things go well in Chicago. We've got guys on the ground in Chicago and in all of our markets that are focused on the market itself, and they're experts in that market.
All right. So guys, Noel has said enough for the skeptics in the crowd to be wondering if this is complete BS, if this is a corporate vision that's going to break down and it's going to be this robotic, depersonalized, non-market specific, knowledgeable type play. You should have some questions. The stuff he's talking about, consolidation, a CSR focused model. Start asking operational questions down below. If you're wondering how down to brass tacks delivering this type of service at scale works, enter those questions down below. 150,000 doors. That is the largest BHAG that I have heard thus far. And I've talked to some pretty aggressive A players in the market. I just want to reiterate, 150,000 doors, 90+% of that is single family SFH.
Yep.
All right. That's what we're talking about.
I'm putting it out there. So, I don't want to have to eat my words later. So there's a lot at stake here. And so we're spending a lot of time and energy right now on which everybody has to do on their processes and technology, and really, really focusing on that so that we can build a model that's scalable.
So the reality is you don't have the luxury of being any other way. Extreme innovation, lateral thinking, scale. That you really have no choice to get to 150,000 doors.
Absolutely.
All right. So, Noel, where do you come into the picture? Why are you the right guy? Why did the company hire you and hand you this opportunity to manage something pretty important? The acquisitions is a big part of this growth strategy. You mentioned that you're getting some more depth of context on the operational side. What was your background leading up to this point? How did you end up joining the company?
Sure. Can I give you my background? I'll start just with my in general real estate skill. I used to be a sales trainer for Tom Hopkins, and some people are familiar or remember Tom Hopkins.
Yeah, Tom Hopkins,
I'm
Brian
not selling anything real estate. So I started my selling career traveling around the country and giving sales training seminars, and it was majorly focused on real estate and maybe car dealerships too. But so that got me into commercial real estate in Chicago. I spent about 7 years in the commercial real estate world in Chicago. The Great Recession hit. That pushed me into really getting into more. At a turnkey company in Chicago, we did about 302 flats in a 2-year period, and still have a lot of those around that we did for investors that at the time couldn't get purchase loans, but they could get refinance loans. So we give them a hard money loan and refinance them out. That put me into the single family rental environment. I started working with a ton of single family rental investors. I started working with a group in Chicago called Elmdale Partners that own the largest Century 21 franchise in the world. When I started on, it was not that was not the case. We did a large brokerage roll up that's very similar to what we're doing with Riddims Warehouse, where they had a centralized model. It's called Century 21 Affiliated. We acquired a ton of brokerages, rolled them into a centralized model. At the same time, we started working with institutional investors in Chicago. We bought hundreds and hundreds and hundreds of homes for Invitation Homes, a lot of other funds, Colony, Waypoint, and then a ton of small, medium-sized investors in Chicago. We did close to 3,000 transactions over 3 or 4 years there. That really got me into the single-family rental space. I moved out to Colorado a couple of years ago, worked with investability and rent range, and kind of got my feet wet on that side of things, on the different side of the business outside of the brokerage world. And then started working with Riddims Warehouse soon after they were acquired by Northern Pacific Group. So I have a diverse background in the single family rental space. In Chicago, we were doing everything from acquiring the homes, renovating the homes, door knocking, leasing, some property management. I didn't get into the operations as much, and now I'm getting more into the operational side as we do some acquisitions in Riddims Warehouse, and it's all hands on deck. So you have to be able to dive into all aspects of the business. So it's been a great learning experience and really understanding the inside of property management, and then leveraging my my contacts in the industry and just the what I've done many times is these acquisitions of companies and creating those relationships, because many times we bring these guys on to work with the company afterwards. So it's not just a one and done thing most of the time.
So it's a relational thing, which is necessary because you're working on the acquisition side of the business that's driving growth. If you were to think about getting to that goal of 150,000 SFH doors, what percentage of that growth do you expect or anticipate to come through acquisitions versus traditional marketing, organic, paid advertising, et cetera? Ballpark with me, Noel.
That's a tough question. I think that I'd probably say, and don't hold me to this, probably say about 30% or more.
Okay.
So you've got to look at it. So we may have a larger SFR investor who says, "Hey, I'm in 5 markets. You're only in 3 of those markets, and we want to get into these other markets. We want one throat to choke. We want one company to work with across multiple geographies. So we'll go look at those other 2 markets. We'll go find an acquisition. We'll find maybe 2 acquisitions. We'll also find maybe another investor that's in that market and really attack that market and scale ourselves into the market." So we're not looking at acquiring and we will, but we don't look at saying, "Hey, let's find somebody who's got 2,000 doors." We say, "Hey, we've got a guy who has 300 doors or 500 doors that wants us to be in this market. We'll go find another operator that's very, very good that we want to bring on our team that maybe has 200 to 500 doors. We'll acquire them, bring that owner onto our team, assimilate the company and integrate the company into our model, and then add on some other acquisitions and try to grow that market as quickly as possible.
So this is interesting. I want to talk more about the two mindsets of the acquisition. Somebody that's looking for a paycheck and wants to balance versus somebody that wants to stay with, keep working with the company. Important distinction. But where I was going with asking you about the makeup of the growth coming from acquisitions versus organic is you guys got your work cut out for you growing on the organic side of things. So what does that look like? To date, some things that Renters Warehouse has been known for, and one of the reasons that some folks in the audience have heard of the Renters Warehouse brand, probably the number one reason would be radio. The company has pioneered advertising by radio, done it aggressively, profitably, had some hiccups along the way. That was one of the early things for me that was really on my radar screen in my discussions with Brenton, because radio was hard. Radio is expensive. You bleed with radio early on until you figure it out and you start making money. And so it has this upfront friction cost that has basically kept people from doing it profitably at scale. On occasion, I talk to people that mention they dabble, they've got a show, etc. But in terms of doing it seriously at scale, Renters Warehouse pioneered that. Talk to me a little bit about that. Is that still a big part of the strategy? How do you guys go about that? Talk to me about radio.
Sure, and so I can also talk about kind of the shift in the single-family rental market, because this is very much part of that. So we really pioneered radio advertising and engaging what I would call the accidental landlords that are now turned into being accidental landlords. So people not realizing that they're going through a foreclosure, they're going through issues, and they're trying to sell their house in a tough market. And we needed to get out in front of those people to let them know that there is an opportunity here to become an investor. And that's where that rent estate comes in. And so we really pioneered the radio advertising. It's still very much a big function of what we're doing, but now we're trying to engage some different types of customers, more of those intentional landlords, to educate them on that there are different types of models for property management. There are different types of opportunities, and you've owned a property for a few years, and now you're not an accidental landlord anymore. You're an intentional investor. And what's happening in the marketplace now is that there's opportunities for lending. There's opportunities to buy outside your geographic area and have the services that you need, from sourcing the property, acquiring the property, getting it rehabbed, and then having it professionally managed, and having the comfort that you're dealing with a landlord that's going to give you the service that you need. And you can even, we talked to a lot of funds, and it's funny, the conversations a year ago was, what market do I need to go into? The conversation now has been, are you in these 5 markets? Great, because I'd like to buy a little bit in each one of these markets to diversify my portfolio. And you can even get into the data of correlations between markets, and buy 2 markets that don't correlate with each other for a lot of different economic factors, so you can spread your risk. And so that's happening on a, it's a slow process of educating these, this asset class are 70%, 75% owned by owners that own 1 to 2 homes out of 17 million. Educating them and penetrating into that is a big part of what we've been doing, and we've been able to do that. And now we're trying to build off of that, through radio, through digital marketing, and we're really expanding how we're marketing, getting in front of people.
So starting off with radio, broad reach, targeting the biggest swath of people, which was going to be the accidental landlord audience, the folks that are more retail, more B2C type. Developing those folks, kind of nurturing those relationships by selling the opportunity of wealth creation, which is a big missed opportunity, right? You're either just serving the immediate need, or you're developing and upselling the new need. So you got some of those folks that you're bringing along and adding new services to, and along the way, you're also catering to a fundamentally different market, up market, the more advanced, demanding, discriminating consumer, the investor, the mid-range investor, the institutional investor, et cetera. But radio was the initial mass market, kind of mass penetration weapon. That makes sense to me. What else can you tell us about the growth strategy. I'll take you to one specific place. Talk to me about the sales function. Another thing, I don't know if I would say that Riddims Warehouse pioneered it, but they were certainly an example of a forward-thinking company in having a centralized BDM function. If for no other reason, they just needed it. The company had sufficient lead volume early on to be able to justify having an ISA function in the Minneapolis market. ISA, inside sales agent, that means butt in chair, phone in hand, sending out emails, not doing sits, no belly-to-belly sales, no in-person meeting the person at the property. That's the leasing agent function. How is the centralized sales function being handled right now, and how will it need to change as the company grows?
Well, so you can only imagine, even if we weren't doing our advertising, and whether that's radio, digital, podcasts, everything that we're doing to bring in customers, managing 19,000 homes, the amount of leads that come in through that. So we like to empower our local team to go out and close deals, and that means I can tell you what has changed a little bit is that not everybody needs to. You're not always sitting down at somebody at their kitchen table in their house that they're thinking about renting. Some of these are more intentional investors, so they want to close a deal now on the phone. And they've like we've learned at PM Grow Summit, you don't always have to sit down and have a long conversation with somebody. Many times they've made the decision by the time they call you. So we train our people to be able to work through those leads, get them to our leasing agents. It's something that is important to us. And having that inside sales function, being very knowledgeable of not only the property management process and our process, but inside the local market that the leads are coming from, and giving that owner the comfort to take it to the next step. And that may be signing a property management agreement right then and setting an inspection, or they want to sit down with somebody, they want to come into our local office and sit down face to face and talk to our leasing agent or our market leader or see our operations. These intentional investors are more concerned about those things because many of them have been through many times maybe not a great experience in property management. So they're more skeptical and they want to understand. They have a lot more questions, and so it's important so those are some of the things that have changed. It's not order taking. It's truly advising them every step of the way on what's the right thing to do, our process, how we work, and what works for them.
So what I hear you saying is both, and you still have the mass market scalable function, which is the ISA, but you also have that higher touch approach for when it makes sense because you're set up to actually monetize to cater to that audience. You can't afford to have the infrastructure if you're not set up to really be able to effectively sell and capture that upmarket client. So that makes a ton of sense. Guys, right now we're going to transition into answering your questions, and you guys have a lot of questions today. All of those questions are down below. A couple of you guys asked questions in the chat. Add those down below. We're going to go through them based on the vote count. And at the top, we have a question from Brad Larson. After a company is acquired by Riddims Warehouse, is there any consolidation of operations? Meaning, are you running the business at scale from a central location?
That's a great question, and it's probably the number one question that comes up when we're doing these acquisitions. So the answer is a little bit of both. When we acquire a company, as anybody knows, or not anybody, as most of you may know, you can't just flip a switch and say, okay, now we're managing these properties. They're all integrated into our process. So we like to take a slow integration period where the company will operate as it is while we're integrating in their model into ours, meaning what I really mean by that is that everybody has a different model. Everybody has different touch points with their customers in different ways that they touch their customers. And for us, it's about not losing those customers in the handover and having as smooth a transition as possible. And what we found is to do that in a slow, steady, deliberate way, meaning 60 to 90 days and integrating the entire business in, not losing doors based on that process, and keeping the churn down very low. So we don't necessarily consolidate. We consolidate the functions that we handle corporately and integrate those in. And then there's functions that are still handled in the market. So like I was saying, all of the administrative work, the payroll and the evictions and the lease enforcement and sales and all of those things start to be handled, and maintenance coordination are handled by the corporate office. And then we just empower that local office to really go out there and grow the business and focus on managing the actual properties. Does that answer the question?
I think that does answer the question. Yeah, that's definitely helpful. All right, so we're going to move on to the next question. What is the formula for Riddims Warehouse to calculate the value of a management company? Do you take into consideration other revenue, fee maximization, or are you just looking at contractual recurring revenue like management fees?
So, what we do is we look at the top line revenue of a company and compare that and their model and compare the two models, because we're not buying the companies and just letting them run on their own. We want to integrate them into our model, which makes us efficient, which is very important for maximizing revenue. So the formula is really taking a look at that revenue, plugging it into our model, and buying and looking at it based on an EBITDA multiple. We look less at the bottom line revenue because everybody's model is a little bit different. There are some other revenue, fee maxing, things like that we do look at if it fits into our model. So we're not looking so much at the repairs and maintenance business, because that's something that we by design do not upcharge on that business, because we want to align ourselves with the owner. So when we're talking to a prospective seller, we're saying, hey, look, these are the fees. This is the model we want to look at. We really want to look at your management fee, your lease renewal fee, your leasing fees, your tenant placement fees, and strip away some of those other things that you're maximizing, because sometimes, in our opinion, that's not always at the best interest of the owner. So we do look at those fees, but we really are looking at that the management fees, the leasing, the tenant placement, things like that.
So I just thought of something from the last question. What's the acceptable rate of attrition or churn? What kind of assumptions do you make when you make an acquisition of how many properties will get churned out just because there's nothing you can do about it during the acquisition?
10 to 15%.
Okay, great. Following up on the answer you just gave. So given what you just articulated, it sounds like what you're saying, there's a pretty tight formula that has less or fewer variables than another company may have in play when making an acquisition, given the fact that you have a very standardized, streamlined model. So what is the range of EBITDA multiple that you mentioned? I mean, give us a ballpark kind of range and talk about the variables that will influence the range,
so
high end, low end.
Yeah, and this will answer a couple other questions on there too. So we have to look at the structure of the deal. We're looking at, when we give somebody a price of what we'll pay, we price it per door, but we're looking at the overall company. It's just easier for us to say, look, per door, we're going to pay X, because that number is going to change on a daily basis up till the day you close, because they're going to lose doors, they're going to add doors. There's some post-closing adding doors, things like that. We look at what our internal EBITDA of that door. And so that could be anywhere, 3% or more, three times or more, 3 to 4 times EBITDA, our internal EBITDA. So that's real hard for somebody to conceptualize that. So that's why we look, because we're not looking at that bottom line revenue. We're looking at that gross revenue, plugging in our model. It's going to spit out some numbers, and then we have levers that we can pull. So we structure these deals usually. If you came to me and said, look, I've got 500 doors, here's my fees, we'll price it per property, because you might have 500 doors with an average fee of $100 a door, but you've got 50 doors that you're charging $30 for because you took a haircut to get your first client. And so we have to value those doors differently than we would the higher end doors. So that's why we break it up to a per address. We underwrite per address the doors. And then there's levers that we look at. So we look at how much we're putting down. So typically we like to put 50% down and do 50% seller carry. we can adjust those numbers, and that adjusts the price. Our interest on the seller carry, the length of the note, the how many what we call material clients that this owner has. So if it's 500 doors with one customer, one owner, that's very, very, very high risk for churn, because that owner could leave at any time. Property management, even more so these days with technology, is becoming more of a transient owner. Owners can move to a new property manager. So we risk the portfolio in a lot of different ways that are going to affect the price that we can pay. Does that make sense?
It does make sense. What about the variance in price per door? If I understood
Sure.
you correctly, you're saying that you're actually pegging a price for what you're going to pay for one door is going to be different from another door on an individual acquisition?
Yes, we average that out over a door price, but a lot of guys will say, well, why is it this? And we'll say, well, these doors here are dragging down your price, and this is why. And this goes into preparing your business to be acquired as well. Having a completely variable fee structure with 100 different owners with 100 different fee structures makes it where you have to price it per door, because those, you can't just look at an average.
Apples and oranges.
Yeah,
I get that. So do you think that this makes you guys any less competitive in the acquisition process as a result of the fact that you are discounting things like the maintenance business, or maybe some wonky fees that are actually driving revenue, but they're not the types of fees that you guys know that you would keep in place, et cetera? I mean, does that objection or pushback ever come up?
It comes up initially until we get into the details of the deal. And when you're talking to somebody who has 50 or 60% of their revenue coming from the property or from the repairs and maintenance business, and we tell them they can keep that business and continue to service a portfolio, it becomes very, very attractive.
I see.
We can be more aggressive. We talk about all these levers that we pull that affect the price of the deal. Even then, we can be very aggressive on our price per door and our structure, depending on a lot of motivations. How motivated are we to be in that market? How well is this portfolio managed? How variable is their fee structure? How well do they line up with our fee structure? If they're line up well with our fee structure, we can be really aggressive. Whereas if somebody's got, like I say, if they've got a bunch of doors that they're charging very small rate for in order to scale their business initially, that comes back to bite them later on when they're trying to sell.
So final question on fee maximization. If somebody has, let's say that somebody's 50-50 in terms of revenue coming from the base management fee versus ancillary fees, they've been creative and done a good job of fee maximization. Do you guys just make a blanket assumption that you will gut those, or at least only keep those in so much as they align with the fee structure of Riddims Warehouse?
So, we maximize our fees as well. So we have some assumptions that we look at it and say, yeah, this guy lines up. We look at what how turbulent is it going to be on the transition? Are we looking at is this somebody who's charging way under what we would normally charge, and then we're going to have to raise everybody's fees? Or are they in most cases, a large percentage of the portfolio, they're charging more than what we would charge. So we're going to be saving the owner's money. So if they charge a little bit less on the tenant placement, we're going to be lowering their management fees by a considerable amount. And that, we value that higher. And so, we put assumptions that are already in our model that where we maximize the fees, and some guys line up really well with that. Some guys don't. Most of the time we're maximizing the fees as well or better than what they're doing.
So no, this isn't a nonprofit. When you talk about giving up some money on some of these fees, charging less, et cetera, you use the term being in alignment with the incentives of the customer. All that makes sense. I'm a big fan, but can you just talk to me how that comes full circle? Is that strategy reflected in the average customer lifetime value, customer lifetime duration? Like where's the payoff for you guys in potentially charging less in some instances when you make an acquisition?
Well, for one, since we are a flat fee model, So if we're in a market and we're $89, or let's say $99 in a market, it's going to be kind of hard to buy a company and then charge everybody $129.
Well, consistency, sure.
Right. So it's consistency, as well as because we have centralized operations and we've learned to scale our business and be efficient, we can afford to charge less, therefore eat into the market share, into that market quicker and be.
You heard it. You heard it here first, guys. Let's quote. This is a good time to quote Jeff Bezos. Your margin is my opportunity.
Yep. So,
all right, understood.
Let's be real. That's what it is. I mean, we could go into markets and charge much more than what we do, but we don't, because we are scaling our business and we have a business model that works at the margins and the numbers that we charge. And so we can be more aggressive. And that's, some guys don't like that, and that's competitive nature, but it's happening in the industry all around. Guys are getting more efficient. Owners are becoming more aware of the money that's being left on the table. Right. in their costs and tenant turns and you name it. And so we're in a more competitive landscape, and we're seeing a lot more guys come in and start to emulate our business model, which is great. Because it's just the level of service is rising in the property management industry now.
I love it. It's great for consumers. The slack is getting taken out of the market. Next question, also from Brad Larson. How are your typical deals structured? Meaning, are you putting down all cash, or is it a structured payout, or hybrid depending on the acquired company's needs? So financing, how payout, how's all that working?
Yeah, so we typically do a note or a cash and note structure. And that could range from us putting down all cash to us putting down 25% note or 25% cash and doing a note structure with the seller. It all depends on the transaction, depends on the goals of the seller or what they're trying to do. If they're trying to really maximize that per dollar, defer taxes, a lot of times they prefer the note, and we'll pay them cash up front. We'll do a note over time. We do, as far as risk, like to hold the note, or like to have the note being held, because for churn, things like that, we don't want to come in and we pay all cash and then all the owners leave because there was there was already some issues with the portfolio. So we look at the health of the property manager as well on, is this a little bit higher risk? Is there more risk of owners leaving, or are there some owners already out the door, and how do we mitigate that risk? And a lot of times by having a note keeps everybody in check.
All right, I'm going to just jump in here, guys, butt right in and ask my own question. Noel, tell me about any nightmare transactions. Surely in all this process, you've had some situations where deals have just completely melted down. That's always the nature of deals. Time kills deals. All kinds of variables can kill deals. When a deal typically breaks down, what are the primary drivers, and have you seen any real nuclear meltdowns?
So, and this is the same thing as in single family investing. It's really easy to buy, right? But it's hard to rehab, and it's hard to manage, and it's hard to, so the same thing goes with property management. I mean, typically deals before closing melt down just because somebody wasn't really serious about selling. All of a sudden their business is going a lot better than they thought it was. They've realized that, being an entrepreneur and being an owner, what are they going to do next? Things like that. So those are usually the pre, qualifying and bringing people on and getting them comfortable with the deal. What typically happens that a deal breaks down after, let's say, an LOI, could be things of just transparency and realizing that it's not what they said or what they thought. The fee structure isn't what they thought. They don't have, it's not just about processes. They don't even know what's going on with their portfolio. All of a sudden, this is a 300-door portfolio, and we realize there's 150 vacancies. Well, it's to manage 150 properties is different than stabilizing 150 properties. There's different things and different models, and we can stabilize, but then we have to price that differently. So we get into the due diligence and we start looking at things and saying, oh, you said you only had one owner that owns more than 20 doors. You have 5, and this is a lot higher risk. And so we start to get in that due diligence, and we really look at the deal, look at the health of everything, and sometimes that can affect deals. But more of it's things that happen operationally with the seller before we get to closing.
Have you ever had due diligence failed to surface issues that only came up post-closing?
Yes, there's always things that come up post-closing. We like to think our due diligence is good enough that we know, what's going on before we take it on. Now, sometimes you may think something's going to be a lot easier than it is, and this is just the nature of the business. We haven't had any deals fail post-LOI so far. Doesn't mean that it's not going to happen. There's always those nightmares after you take something on and it's just not what you thought it was, and you really have to work through it. Luckily, we have the ability to really have almost like a SWAT team go in and really take on that integration and really focus on that portfolio, get it to where it needs to be and performing so we can grow it. Our goal is to grow and not lose clients. So we will put a lot of resources into making that happen. And that's a very important key in the acquisitions, is you have to be able to handle what you not only handle it internally and operationally, you have to really put in more resources on that takeover than you do when you're managing it down the road. So the faster you get to stabilizing it, the more profitable it's going to be.
Big upfront investment totally makes sense.
Yep.
Question from Todd Breen: what is your portfolio services division? What do they do? Shout out to Todd. Noel, what's the story there with portfolio services?
Hey, Todd. So portfolio services is a division in our company that we created in the last year. Its portfolio services is specifically there to service larger portfolio holders. So let's say a guy who owns 50 or more doors, could be in one market, multiple markets. We will give them a one point of contact, different level of reporting. And there's guys who we manage who have 50 doors, guys who manage have 3,000 doors. So those investors require a different level of service. And we've created a division to service them, to have that one point of contact that they deal with, that is constantly working there for them, getting the right reporting they need. And so, we created this division. It's headed, our president of portfolio services is Anthony Kazazian, very well known in the single family institutional space. And that's enabled us to start really working with and giving these larger investors that level of service they need. And it really starts with the repairs and maintenance, the reporting, and everything that they really want that hands-on. And each one is different, and those investors are hard to manage, and you need to do it carefully, because losing a large investor can be very detrimental, especially if you're, depending on the size of your portfolio, the size of your company.
Follow-up question from Jason Bischoff: can you handle apartment building contracts in larger markets based on the high percentage of SFHs?
We typically don't. We typically, we'll look at something that's, up to 20 or 30 doors that we're comfortable managing, but we're really focused on the single family homes. What we've done in some situations where we're looking at acquisitions where somebody's got a wide variety of asset classes that they're managing for, that we will, sometimes we try to help with finding somebody to buy their multifamily doors, or they'll keep those doors on and manage them because they're comfortable doing it. We typically find those fee structures very low. It can be profitable. It's not what we do at this time. We're focused on the single family rentals and small multifamily.
So it's all about dilution, focus, just staying clear on the number one core competency.
Yep.
Makes sense. Question from Chris: how do you manage a 24/7 call center for this? Is it overseas?
No, our call center is local, and we put people in shifts and manage the calls coming in. But everything is local in the United States. It's a big focus of what we do. I see lots of benefits in overseas call centers, but not in our business right now.
All right. Related question from Jeremy Boardman: talk more about the client side CSR and the broader plan. How are you going to nurture the client relationship into a CSR model? Noel, tell us, how is this not going to be a soulless corporate experience? How are you going to maintain the human touch? I think that's what Jeremy is getting at.
Yeah, absolutely. So look, to scale a business the size that we're scaling, not everybody. Let me back up a little bit. So we sometimes look at companies that are, especially in existing markets, we'll say, hey, you've got 100 doors, we'll acquire those doors. that might have somebody that's giving such a hands-on experience that it's almost unrealistic to scale that. But it doesn't mean that you can't give them a quality customer service experience. And a lot of that is, the backbone of that is technology. So enabling and empowering the owner to be able to see transparently what's going on with their property on a constant basis. So they want to know what's going on with that repair. They want to see the pictures, log onto our platform, see all those pictures. That cuts out a lot of those customer service issues, because most of the time people want to know what's going on. They want to know why they had this charge, what happened, why the tenant isn't paying, what's the process. So we're empower them to self-help in a certain extent. And that cuts out a lot of that, touch. A lot of the guys, they may want to talk to somebody, but if they can get their answer, they're happy with that. So we really focus on that technology. And then since that's the backbone of that technology, our customer service reps have that same technology at their fingertips to give that hands-on service and get the answers. So it's not always about having the same person to talk to. It's when you call, you get the answers that you want, and you're not thrown around to a bunch of different departments and somebody doesn't know what's going on and they get back to you 5 days later when they figure it out. So for us, technology is very important to be able to manage that whole process. And that's why we're really switching to that customer service model, where we have everybody who's answering the phone. That person answering the phone isn't also the one out there trying to collect rent, and they just got off a phone call with somebody that was very contentious, and now they have to switch their hats and talk to our customer. It's really focusing on those customer service reps. They're the ones that are touching the customer. They're trained in that model. They're trained in all the different departments, and let the people that are out there doing the dirty work continue to do that dirty work, and let our customer service reps integrate with them and get the answers that they need. And it's just more efficient in our mind, in our opinion.
Efficiency through scale, departmentalization, lowering the labor cost, labor dollars, so you can actually afford to be more generous. Segmenting the requests, because we all know there's going to be a subset of your audience that is the most demanding, the least profitable, potentially filtering those folks out, unless the high demand comes from the fact that they're actually in that good segment, that upmarket segment that's going to pay more, be a more profitable client. Totally makes sense to me. We've got another question here from Jason Bishop. How do you handle retail space, HOA management contracts? The answer is you don't do it. Am I correct?
Correct. Yep.
Simple.
We stay out of that business at the time, especially retail. HOA management, I think, is a completely separate business. A lot of guys do it, and they're successful, and they love it, but it's not in our model.
All right. Interesting segue. You know that there are some franchises, companies, et cetera, that are kind of promoting an opportunity to be able to manage in multiple segments, et cetera. I'm going to guess the answer to this, but what are your thoughts on the opportunity of being able to capture revenue from different segments? Do you see this as being a form of dilution and from core competency?
Right now, yes. I think in the future there's plenty of opportunities. I think that the opportunity in the single-family rental space, specifically management, is huge. It's not realized, and there's a very long runway to make this very successful and big. And I think that if we can look at that down the road, but right now we're focusing on single-family rentals. And I think
so. Your advice to a local operator would be get focused. There's a big enough opportunity here that you don't need to be looking in 5 different directions, learning 5 different things, hiring for 5 different skill sets. Get focused.
I do. It kind of goes back to that. Is it the master, jack of all trades, master of none, or is it jack of all trades, master of all? I think that you can get diluted very quickly. You can have different parts of your business drag you down. I think that the level of service, the bar is being raised in the property management business. So people need to get better at it and help our industry overall. And so stay focused in that area. That's my opinion. Now, I've seen guys who are very successful in all other areas, but most of the time they're trying to sell off their property management business and keep the HOA because they, sometimes backed into that business, and now it's getting a little bit unwieldy.
Makes sense. Next question from Matt Leschber in Austin, Texas, 1836. realty and property management. Matt, if you're in the house, just chime in on chat here. I want to know if you're here live. Matt's question is, what is Riddims Warehouse churn percentage annually in a given market after year 1, 2, 3 with a group of 100 clients as a base? Shout out to Matt. What's the answer to the question here?
Well, so, I think I can answer some of this. We look at our churn, and each market is different. Most guys are looking at churn within their market. So, depending on the market, depending on the type of asset class, as far as, are these A, B, C, D type of assets you're managing, the churn is going to be different. And depending on that, if it's a acquisition, if it's a healthy acquisition, if it was a failing company we're taking over, different things like that. We like to, keep our churn under 5%. Say, but some of that's some proprietary information that we're not really putting out there. But we
the P word, P word, proprietary. I feel you're not giving up all the secrets.
It's a huge focus on what we do, and it's gonna go up and down in different markets, different things, different things happen. So we're really focused on that. The longer you keep a customer, the lower the churn is going to be. So that first year is very important.
All right. Well, that's part of the 11 herbs and spices, but the short answer is keep it as low as possible. Makes sense. Question from InvestPro Properties. Are your ISAs responsible for generating leads via outbound cold calling? Is it all inbound, or are the ISAs doing any proactive lead gen?
So we do have some outbound lead calling. So we separate them out. So the guys taking indoor calls, or inbound calls. That's what they do. We do have some outbound. We've done some call centers. We've done some different things. We empower our market leaders and our leasing agents to be part of that outbound local market lead generation. Since they're not having to get bogged down by the back office operations, they can go out there and really get to know the market, get to know the investors, get to know the realtors, and really bring in a lot of leads. So a little bit of both.
So let's be real though. Outbound is unpleasant. Outbound is on the short list of things I'd rather not be doing on any given day, specifically cold calling people. So the ISAs in particular, not the local market leader, but the ISAs, there's actually a subset of them that are focused on outbound.
From time to time, yes.
From time to time. Okay. Limited campaigns. Sounds like you haven't fully cracked that nut to where it's like a cornerstone growth component.
It is something that we're putting some focus on, but we're touching people in a lot of different ways. So we're getting a lot of those people are coming inbound to us. We do on investors, especially when we start getting into some of the portfolio services division investors, we're a lot of outbound to those guys who own, 10 or more properties, 20 or more properties. We're really focusing there to grow because that's a quick growth. We can offer them services they're not getting anywhere else. And then we do some outbound marketing to leads, not just trying to get them on the phone, but getting in front of them, digital marketing. There's all kinds of things you can do to really get in front of people.
All right, follow-up question from Matt. What is Riddims Warehouse client acquisition cost given the mass marketing? So Matt, can you clarify, are you asking on acquiring a company or acquiring an individual owner? I just want to make sure that we're answering this question the right way.
Seems like an individual owner, I would think.
I'm not a company, new owner for mass marketing. All right, so where do you sit in the org, Noel? I mean, was that something? I'm sure the organization tracks it, but would you even know that offhand?
Not that I can say.
Not that you can say. All right, so let me chime in then. So when I talked to Brenton back in the day, I'm not going to quote any numbers, but when I talked to Brenton back in the day, there were a couple of things that stood out to me. Number one, he had a customer lifetime value, an answer for what is your customer lifetime value down to the dollar figure, meaning he knew down to the dollar what the number was. The second thing was the client acquisition cost for him was a less interesting question than segmenting it by channel. You're experimenting, you're trying new things. When I asked him about radio, for example, he had a number for that. But within radio, are we talking AM or FM? What type of programming, et cetera? Client acquisition cost is interesting, but remember, we want to get specific. So we're not going to get, again, this falls into the 11 herbs and spices category.
It gets very granular.
It does get granular. So it's hard to generalize, but guys, let's make an assumption here that it's high. It's higher than yours is. Why would Riddims Warehouse client acquisition cost be higher than yours? Anybody want to guess? Customer lifetime value, because that's what it is a function of. Their acquisition cost is not based on how they gutturally feel about spending money. Ouch. That spent like a lot of money. $100 for a lead. That feels like a lot of money. The only sensible approach is, what is it as a function of your customer lifetime value? Customer lifetime value is going to be a byproduct of alignment of service, of alignment of incentives, motivations with the client, etc. So if the customer lifetime value is higher, or if you're just more in tune with it and more willing to spend as a function of it, and you're grounded in that orientation, then your acquisition cost is going to be higher, which I'm sure is the case, Matt, with the mass marketing that you're doing. Because you're right, they're spending a lot of money in a lot of different channels.
Well, look at it this way. We buy a property management door anywhere from as low as $500 a door, as high as $2,500 a door. And that fits within our model. So, you can look at it a lot of different ways.
Absolutely. All right. Another question from Chris. What are the specific softwares, accounting services, service platforms that you are using? Guys, let's think about another analog here. Think about Max Nussenbaum, spoke at PM Grow Summit, Castle, pure tech play, VC backed, SaaS first, service second, but a true hybrid company marrying the two. In that context, they're rolling their own. And honestly, because, the young startup culture, software, valley culture, there's quite a bit of pride in rolling their own. I'm guessing there's a little more pragmatism going on inside of the Riddims Warehouse model. But Noel, tell us the short list. What are some vendors we recognize, third-party vendors that you guys use, and what are the areas where you guys are rolling your own from a tech perspective?
So we specifically, we work with SMS Assist on the repairs and maintenance platform. So they are a technology company that has a great platform for managing the repairs and maintenance business. We don't upcharge that business. We think it's a very important business. It's a very important aspect, obviously, of property management. I would probably say one of the most important. So we've worked with SMS Assist to help us nationally manage through their technology the repairs and maintenance business. That's very important. We've used Rently in some markets. But we always show our properties. We use Rently for some of the other aspects that we like about it. On the property management software side, we are building our own platform. It's built. We're testing. We didn't find a platform that served the needs of the individual investor and tenant and owner, all the way up to the larger institutional level investor on the reporting, on the data. And we want to own our data. We want to be in control of our data. We want to have an open platform.
Okay. Well, I'll stop you right there, man. Let's park on that for a minute. We want to own our own data. No, what do you mean by that? Doesn't everybody own their data? I mean, it's your business.
Well, it depends where that data is held and what you're paying for it,
and how you can access it.
And how you can access it, and how you can access that data on any given moment. If you need to call into a help center and say you want to run a certain type of report, or can we get an API here, and it's a closed system like many are, that's an issue for us, because we need to be able to work with everybody. We need to be able to scale our business. We need to be able to work with a large investor who wants to have their own platform and us plug into it and talk to each other. And so we've built our own platform that is open. We can have APIs plug into it, and we're not trying to market it and sell it out there to other customers. So it's very important to us, and the technology side of things is so important right now. So yes, we want to own our data, and that means that we own the data. We own where it goes. It's our storage, and we can access that data and run reports and do with that data what we want.
I love it, guys. This is a meaningful distinction. The vendors in this industry cater to where the median company is at, and the median company in this industry, doesn't have any development resources, is not particularly needy or demanding about owning their data, is open to the idea of working in a walled garden, a closed ecosystem. But as you grow and you graduate, you get more sensitive to those things. Eventually, you realize it could be a business liability issue to not truly own, i.e. have access to your data when and where you want it. A company like this has the resources to actually take a bold step of doing your own thing. I mean, is that practical for most companies to build their own software? No, absolutely not. But what is practical is for existing vendors to offer you basic standards of service. That could mean a customer service rep being friendly and kind. That's a basic operating assumption of quality service. But in the SaaS space, openness and access to your data is another basic request. It's not a novelty. It's not an add-on. It's not a pat yourself on the back. Open data is just where we're at, where things are heading. So expect it, demand it from your software vendors if you're not getting it right now. Next question. How many people do you have on your support teams? I'm thinking if we can like segment that in any way to make it a little more interesting, but let's just start off with that. Raw headcount, raw bodies for different departments. What are you guys at right now? Ballpark?
That's a tough question. I think we're close to 200 employees in our corporate office. It's I'm not sure where we are with headcount in the different departments. We will run a lean operation, but then also plan ahead as we're growing so quickly. We're always ahead of the game. In our corporate markets, it takes a lot less to manage a door than your typical property manager because we have our corporate support. So, we might, we'll have leasing agents and inspectors and a few operations people and a market leader. You walk into our office in Riddims Warehouse in Chicago and it looks pretty slow because everybody's out in the field. You don't have a bunch of people in there having to process paperwork. So I don't know the exact number per department though.
Let's ask another question though. The goal is 150,000 doors. Give me a ballpark goal on a head count. What might you imagine the head count in corporate could inflate to support a long-term goal of 150,000 doors?
Several hundred employees. But one note to that is that as we're going along, we're learning how to be efficient in different ways. And the head count now per door, scaling that to 150,000 doors is going to be completely different. Technology is going to change. Ideas are going to change. Important for us to build a model that is malleable, that we can grow and change as the needs grow for the number of doors we manage.
Makes sense. Next question from Spencer Sutton with GK Houses, another very ambitious operation. How do you begin to grow once you stabilize your new acquisition? I would imagine most of your targets are not trying hard to grow market share, or else they wouldn't be selling in the first place.
So let me just review that question again real quick.
How do you kick into growth mode?
Yeah, so we stabilizing the acquisition is an important aspect. You don't just jump right in and everything's perfect. Guys who, our acquisition targets are one of a couple different types of people. They've either grown their business and didn't put the right processes in place, and now they're losing doors and they're realizing that this maybe wasn't the business for them, or they haven't completely scaled their business and they're at that 200 250 door range and they're not quite making the money that they would like to make, and they're realizing this that the competition's coming and so on and so forth, and they're ripe for takeover or buying. Or there's somebody who's big that we like them, we like their talent, we like what they're doing, they're doing really great, and we want to bring them on our team because they add value to what we're doing. Stabilizing that acquisition, it all depends on what type of acquisition it was, but we have our integration team and our team that's stabilizing the acquisition. At the same time, we've got our marketing and that whole aspect of things coming in and starting to focus on that organic growth in the market. We've got our PST team out there looking for larger investors to bring in to grow that acquisition. And for us, the faster we scale up to 1,000 doors or so, that are even 500 or more, the better it's going to be, the better service we're going to give, the more efficient we're going to be and profitable we're going to be in that market. So there's a lot of moving parts, but they're all attacking it at the same time with a different strategy on growing. So it's not a one size fits all by any means.
So it sounds like in large part, you're not waiting or depending on what the previous owner did. You guys have your own recipe and your own formula for growth. So
yep.
To some extent, what they've been doing up to this point is fairly irrelevant. Great point. All right. So we've got a related question from Alex. What is your methodology for rebranding? So that makes the previous owner's work irrelevant in the sense of the fact that it's a new company, new vision, new brand. How soon do you sunset the brand that you acquired, and how do you think about the value of the previous brand?
So we rebrand, and we do that in that integration period.
Which is, again, 60 to 90 days. Is that what you said?
60 to 90 days. So okay. we'll rebrand during that period. What I've found 9 times out of 10, especially in a new market where we're taking on that owner as an employee of Riddims Warehouse to then turn around and run that market, the value is more in the owner than there was in the name many times. And it all depends, and it's their knowledge, and it's what they've built, and it's that has a lot of value. So we'd like to keep that, and we incentivize, even if they don't stay on with the company, we're incentivizing them through our churn structure, through the note structure, to keep the doors, keep that value, keep what we're buying intact, and then we obviously put it in our own formula. But so yes, we rebrand after that, during that 60 to 90 day period.
Question from Mike. I'm not sure which Mike this is, but the question is, if 70% of your growth is not from acquisition, A, what channels do you find most effective to add doors? Referrals, paid search, organic search, radio, etc. And B, is your marketing now managed from a centralized location, or is it local?
So the answer to that question is all the above. You have to we're looking at every single channel to earn a customer. I'd probably say our long-term goal to acquisitions are 30 to 40%. Short-term, they're a much higher percentage of our growth. And we're looking at larger investor acquisitions, meaning customer acquisition. We're looking at every kind of advertising, referrals. The realtor network is a huge area to get referrals, because we don't do brokerage. So we're not trying to compete with the realtor. We want to create an ongoing relationship. So working with those realtors who are that trusted source of that investor, that's a huge area that we're really focusing on. So it's all the above. And what was the second part of the question?
Well, the second question is who is obligated? Who's bearing the load here of growth in a given market? Let's say Austin. What percentage of the growth do you expect it to be driven by the activities of the local operator versus the activities of corporate?
So we have the marketing doing their thing in that market and really focusing on bringing in the leads for the inside sales team. Then we have our local team that they're also tasked with out there and helping grow the market and get the word out and really have that hands-on touch. So it differs by market, but we really want our market leaders to be managing the leasing agents, managing the business development, and not getting bogged down in the weeds on the operations. And let the centralized services help with that.
But if you had to lean toward one side or the other, who do you think bears the majority of the quota for growth, the local or corporate?
I think I'd probably say it's 50-50. It is, so marketing can bring in a ton of leads. But if you don't have that local presence and you don't have the guys in the market really focusing, and we incentivize our leasing agents, we incentivize our market leaders to bring in doors locally, because the quality of the lead with somebody who sat down person to person and found an investor and brought them in and brought that owner in is the chance of converting that is much higher.
So what about the leasing agents? You mentioned that you do not use services like Rently for having a touchless experience. Why is that? That seems a little counterintuitive.
So we want our leasing agents to go to every showing. our leasing agents work for us. They're not marketing any other properties. I Rentley, I think it's still out there how successful it is to completely remotely rent a property. I think on the quality of the tenant, we offer a tenant warranty. So we want to make sure that we're getting a good tenant. We want our leasing agents to meet that tenant, to go out to the property. It also puts eyes on the property to see if there's any issues. It's more secure. Now we may use keyless entry, to mitigate having to carry around keys, but we right now, for the most part, unless you're, I believe, dealing in a much higher asset class, it's important to have those leasing agents out there, and it's important for them to be involved in that process, and you're going to get a better tenant, you're going to have a better experience for the owner, and so forth.
Makes sense. All right, so we got another question here from Mike. Question is, lots of opinions about Riddims Warehouse out there. I'm sure you're aware. What are the biggest myths or misunderstandings that you've heard about Riddims Warehouse?
Sure. Well, the biggest one is that we're no longer adding franchises. So a lot of people, I talk to people all the time, they go, "Oh, I thought you guys were a franchise." Well, we were, and we still have some franchises. We've brought in many of them onto the team, but that's one of the biggest misconceptions. And the other one is that we don't have a local market presence. I hear that sometimes, because if we're focusing on this corporate model, centralized model, that we are just managing everything from Minnesota or Phoenix.
The mothership.
Yeah, we do the redundant tasks, but this is a hands-on business. So I don't believe that you can, unless you're dealing in a very thin asset class, a very niche market of property management, that you can manage everything remotely.
Fair enough. Here's one I would add to that, is that you guys aren't really property managers by virtue of the fact that it's corporate, this corporate influence. This is the idea that real estate is inherently localized. It's inherently regional. You got to know the street name. Somebody says 7500 Blue Beach Cove, and you need to be able to say, "Oh yeah, I know it."
Yep.
I think from that perspective, the corporate influence is bringing a change that's natural and has come to market after market after market, but there's still some lag here. This relates to question from Dave Gorham. I've noticed some traditional independent operators seem to resent the topic of industry consolidation, acquisitions. Why do you think this is? I'll give you the softball on that one. Noel, why are people feeling a little threatened by this pressure, and how would you respond to that? Because when I think about how people orient, some people think that the point here is that Renters Warehouse or Property Frameworks or HRG is going to put all these people out of business. Some people think that's like the underlying pretext of talking about consolidation. I do not view that as being the case at all. When you talk about getting to 150,000 doors, what I didn't ask you about is market share growth, expansion. And that's the difference between saying it's a zero-sum game versus the pie getting bigger for everybody. What's your take on how SMBs are relating to this consolidation vibe?
So it depends, not to offend anybody, but most of the guys that are truly, really fearful of that maybe are fearing the competition. They're fearing the bars the bars rising in property management, and the bar's been pretty low overall. I think there's some really good operators out there, but there's a lot of guys who fell into the business and haven't offered that level of service that needs to be there. The space is being institutionalized. The owners are expecting a higher level of service. You want to get into talking about single-family rentals in general. There's yield compression as certain operationally. There's efficiencies that can be had that are being left on the table. And I think the more that level of service goes up, the more of for example, what we're creating for our larger investors, that level of service is trickling down into our single owners. And so, why guys are scared of consolidation? It's why anybody's scared of consolidation. Yeah, could you be outperformed in a market? Yes, but it's happening. It happens in every, it's an entrepreneurial world. It's a free market. If somebody can be more efficient, they're going to do it. If the processes and technology is there to make them more efficient, it's going to happen. So it's not just about us or Property Frameworks or anything. We're seeing it with regional or local guys who have grown big, figured out great processes, and they're out there acquiring other companies. It's a natural state of what happened. So I wouldn't fear it. The guys who sometimes you guys fear it because of the fear of they're going to have to put processes in place and be better at what they do. But that's natural in any service business.
Makes sense. Yep. Don't get mad, get better. Question from Brad Larson. During the process of acquisition, what do you typically expect of the company owner once a deal is completed? Meaning, do you demand the owner work for Riddims Warehouse for a certain number of months as an employee, or can they immediately leave?
So we don't demand that they work as an employee of Riddims Warehouse. Sometimes on larger acquisitions, they stay on as a consultant, and we compensate them for that. Many times, though, the deal is tied into some almost like an earn-out, but some churn. So it would do us no good to acquire a company, the owner walks away, and then half the doors leave. Right. So incentivize the owner to make sure these owners stay, and especially the material clients or larger clients. So they stay involved. And it depends on the size of the deal. Now, there's some deals we buy and they walk away and we never talk to them again, and that's it. But we structure the deals to incentivize them to reduce churn, which means they want to make sure that people stay. We want to make sure people stay. The last thing we want to do is do a deal for 500 doors and it turns out to be 250. That doesn't nobody any good. So we incentivize them so they stay involved with us on a high level to keep things running smoothly and have that integration work well. And then some of them, it's they can walk away, but most of the time we incentivize them to stay involved to a certain extent.
All right, follow-up question from Brad. If a management company owner wants to retain any equity in the company for legacy concerns, do you allow this, or is this a 100% or nothing acquisition model? Are they getting a little piece of the pie here? Are they going to have a vested interest in the big picture of success? How does that work?
Typically, we don't. Now, I think that we've always been open to different structures and different models on acquisitions. That somebody can own stock in our company. I mean, so that is something that when you say equity, it's we don't give them equity in that market or of the company of their company going forward or what's going on in that market. I know some guys do that, but typically no. But we're open to different models. If it's valuable enough to get the deal done, we'll be open to a lot of different ways to do it.
So it sounds like there hasn't been a lot of demand for that from sellers thus far?
No, typically not.
All right, fair enough. How are you targeting or locating property management business owners that are looking and willing to sell their accounts? Where are you getting your deal flow from, Noel?
Well, I'm here on this podcast, so that's one way. We get it from all different ways. I mean, we're pounding the streets. We like to take the approach of focusing on a market. The sales cycle is pretty long because most of the times, if guys are doing real well, they're not interested. We like to try to catch them at a point of pain, usually, where they're like, you know what, I'm ready to do this. But how we get the deal flow, it's anything from Googling property managers in Indianapolis and starting down a list. But most of the time, it's through connections of a referral. We put it out there. We pay referrals. If somebody knows of a property manager for sale, we'll pay them a referral if they make a very warm introduction and get us in front of somebody. So it's all different ways. There's not a whole lot of there's NARPM, and we go through the NARPM owners, and you can't just buy a list of property managers. It's very reliable right now. So it's one-on-one.
It's a work in progress.
Yeah, it's a work in progress. We hit the phones. We find some good connectors in a market, which there's always people like that, and say who the good guys we want to be talking to. And many times it comes from investors that want us to take over their properties. They'll give us a list of property managers they've interviewed in the past. So
Question from Mike. As you evaluate acquisitions, what are the biggest mistakes you see local property management owners making that reduce the value of their company in the eyes of the acquirer? And I thought let's talk about that broader than just Riddims Warehouse. You know that other acquiring companies, roll-up shops have different formulas, but just what are the general things that you see are kind of low-hanging opportunities that people could fix if they're acquisition minded?
I think normalizing their fee structure. So, if you have a big bulk of your portfolio, you are charging very, very low fees. That's going to hurt obviously going to hurt your acquisition target. And sometimes the acquirer, they have a certain business model and they need to have a certain fee structure or have a certain, they have a certain cost per door to manage. And if you're charging less than that, then it starts negatively affecting the deal. Things like, having a model that, for example, if you're in a market that people typically charge 1 month's tenant placement, 1 month's rent for tenant placement, and you're charging 25%, well, that's going to make it tough because we're going to be trying to convert everybody over. Most of it is centered around guys who take huge concessions in order to scale their business, and it starts to hurt them later on down the road.
Basic common sense sort of stuff. Analog to that, when Riddims Warehouse is doing consumer-facing negotiations with your average accidental landlord, what are the levers that your sales staff pull to be able to make a deal happen when they feel like it is appropriate to make some concessions?
Well, there's setup fees, there's lease renewal fees. Sometimes that you can work with those. Depending on the investor and depending on the market, management fee, obviously, a larger investor, you're going to give some discounts on the management fee. Leasing fee, we like to really keep in place at that 1 month's rent because we're really empowering our leasing agents to be successful, make money, and find good agents. And when we cut that leasing fee down, it starts to cut down on their income. So there's a few levers we can pull. Some promotions we may run from time to time. Obviously, you probably know this. You'd rather give a discounted fee for a period
on the one-time fee,
rather than discounting the fee perpetually. So, some common sense has to be had there. So,
makes sense. What is Riddims Warehouse average revenue per unit, per month, or annually?
I can't really answer that.
All right, that's one of the 11 herbs and spices. We're not going to get it out of him. I'm going to rephrase the question, Noel. How do you think about the money metric of revenue? Regardless of what the number is, what are the vital revenue-based KPIs that you guys look at, care about, measure, and focus on improving and augmenting?
Well, overhead, obviously, our staff per door becoming more efficient there is super important. But reducing churn and being very efficient on leasing a property and a repairs and maintenance process. All of those things, not only do they make it more efficient for the owner, if you're good at that, it makes it more efficient for us because if you're proactive rather than reactive, it's a huge difference in your profitability, right? So if you're always reacting to all the issues that are coming up, it's going to drag you down, and you have to be careful about the doors you take on and things like that. Even though we're trying to grow very quickly, we're not looking to just take on any door that comes our way because those have a higher overhead. And so really looking at those different aspects, looking at cost per lead and what our conversion rate is. All of those different things, what our churn rate is in 1 month, 6 months, 1 year, you have to focus on granular level on all of those aspects. And those are important KPIs.
How often does the regional nature of the business wreak havoc on the company's desire to have radical standardization, et cetera? I mean, are there any markets that you guys are just hands off on because you feel like that the market dynamics make it such that it's just going to be harder for you guys to make money? And within what's the wildest extreme that you see in the markets that you guys do manage as it affects things like pricing, churn, et cetera?
Well, so, there's some states that are harder to do business in than others. We don't really have any that are off limits as long as there's some factors at play. Is it a good investor market, or is there growth in the rental market? Is it we're in some established markets where the values have gone way up, and it's not a good investor market, but it's a great rental market, so we're still there. Is there larger investors coming in? What's the regulatory municipality atmosphere like? How hard is it to do business there? So there's a lot of different factors. There's really none that are hands off that are egregious. I mean, you get into the more urban areas, they have much more restrictive rental laws and tenant landlord laws. And, the way that we look at things is whatever the most restrictive law is on, let's say, returning deposits, we institute that in one market. We institute that for all of our markets. So we just standardize to the highest level as far as that goes. But it's all over the place. And I do have to say the urban markets are harder to do business in. There's a lot more regulatory issues in the urban markets.
Makes sense. What do you consider to be a healthy ratio of revenue per door coming from the base management fee versus ancillary fees? What do you think is a healthy ratio there?
Well, I can speak to when we're looking at companies. When I see a company that is 75% maintenance revenue, and then the rest is sprinkled out through the business, that's more of a red flag for us. I think, I've heard some quotes in that, that kind of that 50-50 area. It depends on what you're talking about. If you're just talking about management and leasing and things like that.
Let's ignore maintenance. So just base management fee versus any kind of ancillary fees from add-on revenue outside of maintenance or construction.
So for us right now, it's weighed heavily in the maintenance and then the tenant placement. We haven't really started to monetize our owners in different ways. I think down the road, there's a huge opportunity for that, more in the advisory, the rent estate. So right now it's heavily focused on the management fees, but just for sure to understand is that there is a huge opportunity to monetize in a positive way the owners with a lot of ancillary services and strategic partnerships and relationships, and really get into that, what we call that rent estate advisory. And the important aspect and the important keyword is that in a positive way. So
I like that. Advisory. Clue in on that word, guys. That's an opportunity to be the trusted advisor. So needless to say, you guys are 80-90% per door revenue coming from the management fee.
Yep.
Awesome. All right. Question from Alex Fortranberry. When it comes to organic growth, how do you structure your sales teams? Are they doing all the follow-up locally, or is it handled from the corporate office? You've kind of touched on this before, but yeah, I'd be curious, at what point does handoff happen from a centralized ISA function to boots on the ground?
So it happens when we need to consummate the deal with with somebody locally in the market. So it kind of goes to the local market to consummate the deal, meet with the owner if that's what they need, get them signed up. Then they're back dealing with their centralized services, but we're doing an inspection. It depends if the owner is local or out of their geographic area. We're doing inspection, giving them advice on what they should rent the property for, and they're working with our centralized team on that, as well as our boots on the ground. So it's a little bit of both, and it depends on where they are in the customer timeline.
Makes sense. Question from Mike. How long does the typical SFR owner keep their home under management with Riddims Warehouse? And I guess what kind of assumption, when you're making an acquisition, what kind of assumptions do you make about customer lifetime duration? How many months are you assuming?
We like to assume about 5.5 years.
5.5 years, guys. Wow, that's really aggressive.
So, but
think about that.
But as well,
wow.
though. Yeah, but think about that, and then think about as it's changing and as we're growing, that's kind of a moving scale, because you don't know at scale and you don't know in the new marketplace
Sure.
And per market, it's different, because if you're in a highly appreciating market and you've got accidental landlords, those guys are going to be looking to sell their home at some point, maybe.
So this ties directly back to Matt's question about customer acquisition cost and why it's higher. 5.5 years is not mind blowing to me in terms of it being that long. What that is impressive is the aggressiveness and the optimism associated with using that as an operating assumption. Most people's customer lifetime value is low because they take a very conservative approach on estimating how long customers are going to stick around for. 12 months feels comfortable. Anything beyond that, and you're kind of asking people to make a little bit of an act of faith there. Last and final question from Brad Larson: when you were acquiring management companies, do you have a formula that you target? 100 doors, 250 doors, revenue amount, geographical locations. Give us one more time. Put it on the index card for us, man. What are the cliff notes of the basic formula that you use, that you sit down and that you walk a prospective seller through?
So typically we're looking at most of our acquisitions. Now, there are some outliers that are the 1,000 door plus type of acquisitions. Typically our acquisition is somebody who's between 250 and 600 doors. We would typically pay between, like I say, as low as $500 to as high as $2,500 per door. We target markets in two different ways: existing markets, where we're targeting just contract acquisitions, and new markets where we're targeting strategic acquisitions. And those, that conversation is real simple. It's, talking through our process, who we are, getting them to know us a little bit, and then it's data. We're looking at data. We're looking at per address, a rent roll, what their fees are per property, and we turn that around pretty quick in 48 hours and start a negotiation and say, this is where we're starting at. Let's say we're starting at $1,200 a door. These are the levers that you can pull, and this is why it's not $1,500 because of this group of properties. We try to be very much transparent to let them know why it is so high or so low, or what's affecting this, because that gives them an opportunity to rectify the situation and maybe come back later, or just, knowledge is power. So
that makes sense. So from the point of having a serious conversation to getting an LOI on the table, how long does that take? And then from LOI to close, how long does that typically take on average?
So conversation to LOI is as quick as they can get us the data and we can agree on a price. So that could be 6 months. It could be 1 week.
What's the data that you need for due diligence?
I need a address level rent roll, at least 2 with zip codes. Sometimes we hold back the addresses for a later time. I need to know the rent, the management fee, the tenant placement fee, and the lease renewal fee. And then we like to know in general, what are you charging for application fees and late fees and all of those things, but that's just a static number typically. Because a lot of times we find that somebody has a portfolio of 500 homes, there might be 30 different revenue, for each store. It might be a little bit different, because many times it could depend on the time of the month when they took those doors on, what they negotiated or how well they negotiated or didn't. So we need that data, and we can turn around and give an initial quote. We can plug that in and say, okay, we're at a certain price per door with these types of structure. And then if it moves on from there, we want to get some more information, understand the material clients, and move forward. So it can go.
So that's enough to get an LOI or an offer on the table. But then beyond that, in terms of the due diligence process, how painful is it for the seller, and how long does it take to get from LOI to close on average?
Typically, LOI to close is 30 to 45 days, depending on how many deals we have in the pipeline at the time, because we have to be very deliberate about taking on deals. So sometimes it could be pushed out a little bit longer, and so let's say it could be 30 to 60 days we could close, and then we'll have that integration that could be 30 to 90 days even. It all just depends on how complicated the transaction is.
So what kind of data, what are the data requirements? I can imagine that this could be potentially really intimidating for somebody to think about selling this, the due diligence process seeming like a nightmare.
It's good. So we also so if you've got great processes in place and you have all of your leases, your management agreements, exactly what's going on with your portfolio, for one, that's more attractive to us, so we pay more for those, and that integration period is a lot easier. It's, so we need a copy of all the leases. We need, usually if you're in a platform, we'd want to be able to log into your platform and really look at the data and look at everything. More of the due diligence, we're really verifying the information that's been given to us and making sure there's no major deviations, so that the spreadsheet you sent us is not different than what reality is. We don't see that very often, but sometimes there's small deviations there. But the due diligence is more of just handing over all that information, letting our team go through it. So where guys get tripped up is there's no one property management platform that lets you download all of that data in one report. There's not, that I know of. So you've got to run separate reports. So we'll even send instructions. Oh, you use AppFolio? Here's what you need to do to get us all the data. And we'll give them a step-by-step guide on how to do that.
Makes sense. All right, the real last question. We had one more come in just now from Mike. How do you handle existing local employees on an acquisition? I've been running this local shop. It's my baby. These are my people. These are my family, etc. You going to fire all these people and bring in a bunch of people from corporates, bunch of suits? How does that work with local employees?
No. So if you think about it realistically, a couple of things happen when there's an acquisition. And this is just from personal experience. You've got some employees that are already out the door. They're on their way out. So when the acquisition happens, that's an opportunity for them to leave. There's some employees that probably weren't employees that you would recommend to go for it in the first place. So during that integration period, it all kind of works its way out, as well as, we don't need somebody doing accounting. We don't need somebody doing, certain functions, but they might be very good in property management. So we'll repurpose them to do another function in that local market. What makes us work well and efficient is that we can, in a local market, we have less employees per door. So there is going to be some people that aren't going to work out, but we don't come in and fire everybody, because that would be hugely detrimental to the deal and the overall health of the transaction. So we like to work that through, and in my experience so far, it's worked its way out. It works its way out organically. The good employees are going to be excited, and they're going to come, and they're going to want to, do something different within the organization. And there's those opportunities.
Makes sense. All right, guys. So we're going to wrap things up now. Long list of questions. You guys are really engaged. Noel, thanks for taking the time to talk with us, guys. If you want to know more, if you want to interact more with Noel, come to next year's PM Grow Summit. I'm sure he will be there again. But in addition to that, if they want to talk to you ASAP, Noel, what's the best way for people to get in touch with you?
The best way would be to just email me. It's noelc@riddims.com. Find me on LinkedIn. I'm very active. I'm very responsive. If you go on my LinkedIn, there's a Calendly link there, which is calendly.com/NoelC, and you can book a time on my calendar. I'm very accessible, and even if it's just to talk about your property management company, see if it's something you'd want to do to sell or to get some advice or whatever, we like to be there to help. So.
All right, guys, Noel's going to drop that link in the chat, that Calendly link. Noel's just going to drop that in the chat on the bottom right so you guys have access. Thanks for joining us again. We will be back in the near future. Hope this was helpful. Thanks for showing up, guys. Have a great day. Wish you well in your business. Talk soon.
Talk to you later.
Bye-bye.